Hey, welcome to Alpha Insights. I'm Daniel Snyder. Thank you so much for joining us today. This new series from Seeking Alpha is to help you, the everyday investor, retail investor, financial advisor, anybody and everybody, help understand what is going on in this market. We're going to have a large array of different people that we have in our marketplace services, as well as from around the internet and other financial services, come on to help you understand what's going on in this crazy market. So to start off, I just want to do a quick overview of year to date. What are we looking at with the markets? Year to date, the Dow is up 19%. The S&P is up roughly 25%. The NASDAQ up 24%. Bitcoin is up 133%. Ethereum 552%. So without further ado, I want to introduce who is on the program today. We have Jay Mintzmeyer from Value Investors Edge, Eric Basmachin from EPB Macro Research, and Michael Gayed from the Lead Lag Report. How are you guys doing? Thanks for joining us. So I want to dive right in. Fed. We had the Federal Reserve come on last week. They announced the taper. We know it's coming, the amounts, when it's going to end. We're working through it. So what does this mean? Eric, why don't you go first? How do we break down what happened with Powell and the Fed?
Sure. Thanks, Daniel. And excited to be on a panel with Jay, Chris, and Michael. To contextualize what's going on over the past, since the depths of COVID, the Fed has been purchasing $120 billion per month of Treasury and agency paper. 80 billion of that's been Treasury paper, 40 billion of that's been MBS. And the effect of that, what that does is that increases the growth rate in the monetary base. The monetary base is a large contributor to the growth rate in the M2 money supply. So basically the Fed's been providing ample dollar liquidity to the entire world, which has helped facilitate, a risk-on environment, and it's helped push market inflation expectations higher, although the Fed does have very limited control over actual inflation. So what's going on now is the Fed is going to reduce the pace of those purchases. Now, this is different than the quantitative tightening episode of 2017, 2018, where the Fed was actually reducing the size of its balance sheet, it was actually selling securities. Now the Fed is just going to be slowing the rate of purchases. So we're going to be going from 120 billion per month to 105 billion per month. And then in December, we're going to do 90 billion per month. And then the Fed has left it open-ended after December, which is interesting because the last time they tried this exercise, they used the term autopilot, suggesting that we were going to run down at a pretty constant pace, regardless of what happened in the market or the economy. It didn't go so well last time. December 2018 was a big scare. So this time they're going to try and leave it open-ended, and they're going to see what happens after November and December. So what do we see happening so far? As soon as the taper has been announced, we've seen a pretty serious yield curve flattening. That means that the short-term rates are coming up and the long-term rates are coming down. When you contextualize this flattening with a decline in the growth rate of the monetary base and an increase in the US dollar, those three things together generally indicate tightening monetary conditions. So although the Fed literally just announced it, this was well telegraphed. The market's been pricing this in for some time. So we are entering a window where monetary policy is going to be increasingly tight. That may sound pretty, it may sound a little bit counterintuitive to most people looking at the size of the balance sheet or the fact that they're still doing quantitative easing, but everything in markets, everything in the economy is what we call rate of change. It's the directional change that's most important. So if you go from a purchase of 120 billion a month to purchasing 100 billion per month, in rate of change terms, that's tighter than you were before. So the Fed is moving in a tightening direction. The growth rate in the economy is coming down from this supercharged pop that we had out of the COVID recession. So we have declining growth rate. We have the Fed that's moving a little bit tighter direction. The yield curve is responding by flattening. I'm sure some of the panel members have some more takes on what that may mean for the equity market, whether they agree or disagree. But as far as the Treasury space, that's what we see going on and what the taper means.
Yeah, and you mentioned that during this time, it's been risk on after risk on after risk on because they've been printing money and buying all of these assets. Michael, you're the king of risk on and risk off, man. Like, what are you seeing from your side of if we've been risk on so long and now they're tapering, does that translate to risk off, or how do we interpret this?
Well, I think first we got to define what risk on, risk off really is. right? I mean, I take issue with the idea that risk on is about direction. It's about it being a green day versus a red day. In my world, risk on, risk off is about conditions that favor an accident, right? Some kind of tail event, some kind of correction, some kind of higher volatility juncture. And I always use this line on Twitter: just because it's raining doesn't mean you'll crash. Just because it's sunny doesn't mean you won't. I'd actually argue there were quite a few risk off junctures this year, but we had no accident, even though, based on the work that I do, it was raining outside. Now, a couple of things on treasuries. I think Eric is, and I'm a huge fan of Eric. I think Eric's spot on a lot of things. I've been alluding to this idea that I think the bond market is sensing something, right? Initially, I thought, okay, maybe the bond market with the yield drop that started mid-March is anticipating some kind of a credit downgrade, just like what we saw in 2011. Because if you look at how 2011 behaved, 10-year treasury yields started dropping before the S&P downgraded U.S. debt. And given that U.S. debt is not going down anytime soon, it seems to me that that's still a likely possibility that you get some kind of downgrade from the credit rating agencies. I do think there's also still the possibility that you have some kind of other exogenous event. Well, I'm sure we'll talk about it, but it seems like there's some rumblings around China and Taiwan, which maybe the market is underestimating. And all that, you'd say, well, that would suggest that we're probably in a risk-off environment, or probably soon we're going to have one. And I think that the signals that I track seem to suggest we're kind of moving in that direction yet again. The fact that treasury yields have been dropping is a risk-off signal. I've proven that in one of the award-winning papers I've put out. Lumber to gold, one of the relationships which got a lot of buzz this year, is starting to weaken again. That signals a disinflationary pulse might be coming. And utilities are so bombed out relative to every other sector of the stock market that I can make a contrarian argument that utilities will be the best performing sector in the next 6 months, just from a mean reversion standpoint. When would that happen? Under what conditions would that happen? A risk-off environment. So, I know everyone's excited about stocks hitting new highs, and keep in mind, most stocks did not hit new highs until last week. I'm seeing that based on the Russell 2000. Okay. But, when you have this much optimism in the face of what could be another storm coming, you got to be careful. Yeah, we got through most of these storms this year, and, it looks like everything is normal and fine. Treasuries would say otherwise.
Right. If I can add one point in there about this risk on, risk off, we mentioned some double-digit numbers for stock prices, and a lot of people look at stock prices and try and make their assessment based on that. But if we look at long duration treasury bonds from that March peak, they're up almost 20% in price gain terms. So when people look at bonds, they look at the yield, they say, I can't make any money in bonds at 1.5% or 2%. They're not understanding the fact that there's a duration component to these bonds. And if yields on long duration treasuries fall from 240 to 180, that represents a large price appreciation. So when we're looking at stocks, are stocks really rising in excess of the decline in interest rates? Not really since March. So they have been marching upwards, but a lot of that is just simply for the fact that the rates have been coming down.
Right. But so, as you mentioned and alluded to, the bonds aren't returning a lot of yield, and cash is definitely not returning yield, and crypto is now involved, and gold prices haven't been going up as high as people would have anticipated for a risk-off kind of environment. And I'm just wondering, Jay, being in the supply chain world, obviously we're all looking for the next place where we're going to get our yield. And Michael brought up a great point about China and Taiwan and the semiconductor issues that we're kind of experiencing from that as a result. Is that something down the road that would impact shipping industry, or is there still money to be made there and find yield there, even though everything else is kind of, where do we put our money now?
Yeah, it's a very good question, Daniel. And of course, Eric and Michael have more to say on the broad Fed topic than I do. So I appreciate you steering me into my lane here. In terms of shipping, we had a great webinar the other day hosted by Seeking Alpha where we talked about how it's actually 6 or 7 different subsegments. And a couple of those do have a lot of focus on China. And the biggest one is dry bulk. And we have seen a significant correction in the last 5 to 6 weeks in dry bulk. You can see that with the BDI, the Baltic Dry Index. And there's a lot of factors into that, but sort of the precursor or the backdrop was the Evergrande credit concerns in China. And so if I'm looking at anything, I'm concerned about, it would be more so China than the US Fed. The US Fed, it doesn't impact me quite as much. Most of the stuff that's going on in terms of supply chain crisis, you can argue the Fed might have been a leading cause of that, but it has a lot more to do with congestion and COVID hangover than it does with the Federal Reserve, in my opinion. If anything, maybe fiscal policy is more of a leading indicator there than monetary policy. In terms of shipping risks to China, a dry bulk industry is front of that. Not only Evergrande, but China is also dealing with an energy crisis. Because of that energy crisis and shortage of coal, they've shut down or idled a lot of their steel mills. So not only are we seeing the demand crash or potential demand crash from property development, we're also seeing the government stepping in and outright halting some of these steel mills. So that's leading to a crash in the demand for iron ore. You have to import iron ore and metallurgical coal to make steel. If you look at the iron ore prices today, you'll see a chart that looks very similar to lumber. In fact, it's actually worse than lumber. We're actually below most of the prices of mid-2019 right now. So that's impacting the sentiment for dry bulk. The rates are still pretty good on the mid-size. We like the mid-size stuff a lot, but the rates on the Cape sizes, the large ships that carry iron ore, they're not doing real well right now.
Yeah, that's great insight. And to go back to what we were discussing about where do you find yield? Well, I think everybody's kind of noticed, and they continue to hear about more and more, SPAC mania. Right? SPACs have become such a hit thing in this market for people to go and get yield from owning the warrants or owning the shares. And so I actually want to introduce Chris DeMuth Jr., who's joining us today, Sifting the World, found here on Seeking Alpha. Chris, how are you doing? Yeah, thanks for joining us. Now, I bring up SPAC mania, and I've got some information here that I just want to read off. So far, in 2021, more than 512 SPACs have debuted in the US, raising nearly $140 billion according to SPAC research. Last year, which we thought was SPAC mania, 247 were listed and raised $83.4 billion. Now, the kicker is we now have Kevin Durant, an NBA star, that wants to start his own SPAC. Is this the only way we can make yield now? Break this down for us, please.
Well, it's been an interesting year for SPACs. It was dramatically hot, then dramatically cold, and we're kind of entering a third phase of the year that I think of as meritocratic, where they're much more differentiated. Earlier in the year, even terrible things could do really well. Then for a while in the summer, wonderful things were doing horribly, and now we're kind of seeing a lot more of kind of valuation sensitivity amongst sponsors and amongst specific SPACs. Getting the supply and demand in equilibrium is almost impossible when you're dealing with so much new supply. I have to say, as a practitioner in the market, it was a little more subtle than that, because all of these things in the primary market, especially before they file, is negotiated with investors. So if I'm going to participate at scale, typically we are looking at 5 or 10% of any issuances that we invest in, I'm going to buy. We always call it a negotiation, but in a hot market, it's closer to begging. So I would say I'm negotiating with you, but really I'm just throwing myself at your feet and asking. My participation is my ask, but by the time you got to the summer, my participation was my give. And that becomes, again, not a negotiation, more like a hostage term sheet where you're just kind of making demands. And in many cases, somebody to get a deal across the line would do it. And now it's a lot more subtle. Now it's a real conversation. And the way I think of it today is when somebody's trying to get a deal to the market, we're trying to be good partners so that they can get the very highest quality founders to want to combine their company with them. So I don't ever like to be short-term greedy. I want to be a good partner so that we have a really good cap structure, well capitalized, where I can come in across the process in the IPO, in the pipe, later on in the secondary market to really support whatever deal they find. So I think it's kind of balanced, it's more normal, and that we've really found, opportunities from the previous cycle of spectacular destruction amongst companies that are not dead but left in the bargain bin. Mania over companies that are probably pretty hard to justify, and then some kind of some strong new opportunities.
Yeah, but let's break this down for the viewers right now. Like, what SPACs should people be looking for, right? There's only so many private companies that can be taken public or have good enough, fundamentals to even warrant bringing them public. So where do we look?
There are more SPACs than public ready companies. So you're going to have something, I mean, I'll just not formally, but just approximately a third will just be liquidated. Approximately a third will have to completely restructure. And so the sponsors will basically give up their equity, and a third will get done. Happily, it's fairly analyzable which ones will be in which category. So, when you look at really good sponsors, they have a much better relationship with the market, and they typically have much more capital they're bringing themselves. I didn't care that much a year or two ago, but now one of my first questions in the testing the water calls where we're talking with the sponsors about new SPACs is exactly how much capital they have to bring so that they can fill with contracts and with pipes, whatever the outside doesn't want. Because you're in a very good position if you say, hey, we'd like your capital, but we don't actually need it. We're going to get this done one way or another. And if you're trying to do, to dramatize it, $100 million SPAC, but I have $10 billion on the sideline, I just want to have this separate vehicle. There's really no risk that it doesn't get done. So you want somebody who is very, very, very rich, very, very, very well connected, some combination thereof, but not just kind of Hail Marying this one thing, hoping that the market likes it a few months from now.
Yeah. So correct me if I'm wrong, but it sounds like SPAC mania can continue is what you're saying, but within specific SPACs.
Yeah,
don't go over the general SPAC market.
I've written about, I think this quarter, even this half a year, I've written about a pretty small, I haven't been particularly prolific. I wrote about kind of an old one, a new one, and then have a next one coming up. And then I picked one unjustified mania, one unjustified debacle bargain bin. So I think I'm up to 4 I've written about, one I'm about to write about. But there's some great ones. I mean, my favorite sponsor is called DMY. The last deal they did was IMQ. That was something that, disclosure, I'm long their warrants, I'm long at every which way it could be. And I typically am with the sponsor, and it's typically a very, very concentrated position for us. It's a little misleading to look at performance, since it's out of the gate. I wrote this up. This is one that I wrote up for Seeking Alpha in mid-September. It's up 120%, but take into account that on its way to making $12, you were risking 1 penny. You weren't risking $10. You were risking a penny, net of the free embedded put that comes with the equity when you own it as a SPAC. And so you get a free peak. So it's a guy and a pile of money. And in this case, the guy, and not exactly a disclosure, but he's a friend of mine and somebody who we kind of partner on these things with me as an outside investor, but we do it kind of on a durable basis. He's very, very, very good at doing deals. He's also well positioned to be a very attractive SPAC sponsor. So if you have a company, in this case, IMQ, we can make certain that the deal is going to get done. There's no real deal risk. It's just a way to come to the market with a very good tech partner. And that's one I still love today. I think that's a terrific deal. I think he's a terrific sponsor and has some interesting things in the hopper as well.
Yep, Chris, so let's wrap it up. Kevin Durant, his SPAC, investable or not?
Not for that reason. I think I've gotten involved in none of the kind of celebrity SPACs, or at least the sports celebrity SPACs. I've been on a number of calls, so it's been if you're investing for entertainment value, I think it's an entertainment value topic. I don't think it's kind of one for capital beyond that. But nothing wrong with entertainment value.
Right. Perfect. Thank you so much for joining us, Chris. Take care.
Thank
all right.
you.
All right. Jay, I come back to you after SPAC Mania. We got to talk supply chain disruption. You are the man, the myth, the legend that can break it down for us. Obviously, we all know inflation is going higher. There's demand, but there's no supply. Investors are feeling it. Everyday people are feeling it. where do we look from here? How long is this going to go on?
Yeah, it's a good question. You hit it right on the head. I'm glad you didn't ask me about SPACs. So yeah, we just had a report out this morning. It was on CNBC saying we had 8% inflation into October, and it was the highest wholesale inflation on their record. I didn't see how far back their record goes, but certainly in several decades, it's the highest reported inflation number. As far as how long the supply chain congestion is going to last, there's actually 12 or 13 different bottlenecks along the chain. A lot of folks have heard about the factory disruptions and issues out of China. A lot of people now have seen pictures of the ships queuing off of LA and Long Beach. But there's another disruption almost every step of the chain you go. There's too many container boxes in the ports. There's not enough chassis to load these on the trucks. There's not enough trucks. There's not enough drivers. So there's not enough warehouse space. You can go on and on. It goes across the United States. We think we're past the absolute worst of it. Our prediction before was mid-October to mid-November. And that's not because we're geniuses or anything. That's just the way it happens every single year. I mean, it's a seasonal market. Every mid-October, this thing gets tight, but it doesn't blow out. You don't see 80 ships in the water. You see like 25, right? So this is an extreme version of that, but it's still a seasonal market. And we're seeing that seasonality exactly. I think we're actually past the absolute peak. In fact, we've seen the freight rates coming down a little bit. Now, when I say a little bit, they're still 90, 95% of the peaks. So it's not like I saw one misleading headline that said freight is crashing. Well, that's not true. Freight's down 5%, 10%. But it's a seasonal market. And so we think it's going to start improving from here on out. However, the seasonal trough, the best part, if you will, the most free flowing the supply chain ever gets is usually around February. And that's for two reasons. One, we're past the US holiday season. So the shoppers are pulling back on the reins a little bit. There's less demand pull there. Number two, China is in their Lunar New Year. So there's a lot of factories shut down for a week or two. So you have a little bit less of a supply push out of China. You have a little bit less of a demand pull out of the United States. It happens every single year. So what I'm getting at here is I think the freight rates are going to soften a little bit. Things are going to a little bit better through February. But then we get March, April, May, and we're gearing up for next year. And everyone's learned all the lessons of what happened this year. All the suppliers or importers that procrastinated they're going to get stung this year. And so we think it's going to ramp right back up. Now, is it going to go all the way back to these all-time highs? I don't think so. I don't think anybody's really expecting that. However, I think 2022 is going to be very elevated in terms of freight rates and in terms of delays and backlogs compared to like the 2010s. The 2010s were an artificially low segment across all of shipping. There was massive oversupply of ships on the water from 2008, 2009. There's huge hangover in ships that kind of spoiled everybody, I would say. I think a lot of American importers and American consumers got spoiled by artificially low subsidized freight for a decade. And I think that era is over. I think 22, 23, 24, we're going to see higher freight costs. Now, everybody wants to thread the needle. Everybody in shipping wants good freight rates, but we don't want to crash the economy. So I was actually getting worried in September, October. These freight rates are too high. They're not sustainable. I'm feeling a lot better today when I'm seeing those freight rates are strong, but they're normalizing out.
Yeah. So Michael, if I can get you to jump in here, I mean, obviously they say if what Jay is saying is true, where supply chain is starting to calm down a little bit, but the consumer remains strong and the demand is there, don't we see this continuing on in regards to, lumber prices potentially going back up, maybe even, right? If people are coming back ready to spend money, but what if the cargo ships coming from China may be full, but what if we can't get lumber? Because obviously supply and demand still affects there. I mean, do you have any thoughts or insight on that?
Well, I mean, I think the way you're thinking about it is correct. I will say one thing about the term artificial, Jay, that you mentioned. I do believe, and maybe this is me being a little conspiratorial, but in a world where more and more industries are defined by oligopolies, by just 2 or 3 companies that define an industry or a sector, that it seems like supply chain disruptions are a convenient excuse to keep prices high. So I do think there's an artificial element about where prices are because, yes, there's a lot of demand from consumers from all the stimulus, but there's also now a great scapegoat as far as why you can keep those prices high. And you don't really have much competition. Just I'd be curious separately, Jay, to kind of hear your thoughts if there's some element of truth to that. Now, you're hitting on sort of a bigger question about if we're entering some kind of super cycle for commodities or just a cycle in general for commodities that's not transient. Maybe, but you would think that treasury yields would be rising if that's the case. right? Because what's the link? Why do I always talk about lumber and lumber relative to gold in particular? Because it's about housing. Well, housing affordability pretty much sucks now. And it's hard to see a scenario where you get another massive boom in home construction, given how extended I would argue that the system is in terms of overall leverage and debt, which is, again, probably why yields are staying low and why the yield curve is flattening. The irony about all this discussion at the start of the conversation here is that yields are low because yields are low. In other words, the reason they keep going down is because you have so much debt to service. And the lower yields are, the more debt increases, the lower yields have to be to maintain that debt. So you're kind of in this very nasty kind of cycle, I think. But look, I keep using this point. I very much am of the belief that if I'm going to be bullish or bearish on anything, I'm going to be bullish on downside surprises. Right? Yes, you're going to have lumber rally, you're going to have lumber collapse. Yes, you're going to have iron ore rally, you're going to have iron ore collapse. You're going to have more volatility. We are spoiled this year with the smoothness of the move in large caps. There is going to be more junctures where the market itself is going to act more volatile. And that's okay. Everybody listening to this should want to see markets go down. I'm pretty sure buy low is still a thing. But somehow people forget that when they're just seeing the S&P rise to new highs and they're seeing their cryptocurrencies rise to new highs, forgetting that time is on your side. You actually want to buy at lower prices. And I think that's still coming.
Yeah, so I just got to go back to Jay real quick. Jay, any thought on the price point that Michael brought up?
Yeah, I think Michael brings up an interesting point to consider. And I mean, in terms of being bullish on the container liner sector, one of the points we always bring up when we're bullish is, hey, look at all this consolidation. It's turning into an oligopoly. However, the scapegoating goes both ways. You can argue, okay, yeah, there's an oligopoly, and maybe that's helping restrain the forward supply, and maybe that's helping keep rates a little higher. But it also goes the other way in terms of when the US government is panicking or they're in a political tight situation, it's so easy to blame a foreign scapegoat, right? It's so easy to say, oh, look at all these major container lines, because look, all top 10, all top 15 of them, they're all foreign and owned. The only domestic major liner, it's not even major, it's like maybe number 14 or 15, is Matson, MATX. It's the only domestic one that's even and they're a bit player. And so it's so easy to blame that and say, look at all this consolidation. The consolidation has gotten to a point where it's starting to help rationalize supply, which is a bullish thing for investors, but it hasn't got anywhere near the point where there's like control of prices. I mean, we have the top 5 that control 60%. That's a healthy consolidation. But if you look at any industry, top 5 control 60% is not like any sort of like trust or oligopoly or monopoly or whatever you want to start calling it. So we're not there yet. I think it's very similar to like US airlines. US airlines were terrible investments for decades. Right. And now we've seen consolidation. We've seen alliances on air traffic, and we've seen profits rise up. But we're not really an oligopoly in air traffic either. It's just a healthy industry. It's healthy for investors and it's healthy for safety as well.
Yeah. So Eric, he brings up airlines. Obviously, oil's been rising. Oil is a big component of planes. We're not going to be able to make electric planes anytime soon. Would you say that it's a good investment for investors at this point in time?
Well, I'm not an expert on the oil industry or the airline industry specifically, but if we're looking at the whole transportation sector, generally the sector tends to do well when the economy is accelerating, and it tends to do poorly when the economy is decelerating. From my point of view, the economy is decelerating. The way that I judge that is an empirical measure. I try and not make it an opinion. So if we take what I call the 4 corners of the economy, we look at real consumption, total employment, industrial production, and real income, and we smash those 4 indicators together, we can see that the growth rate of the economy peaked in March, and it's been declining basically every month since then. Peaked at about 7% based on the way that I measure it. It's declined to about 3% now. So the question is, where do we go from here? Are we going to reaccelerate going forward, or are we going to continue to decelerate in terms of the growth rate? For that, we use various things, a lot of leading indicators. Quick point is that the growth rate is going to continue to decelerate over the next several months. So I personally would be positioning my portfolio for that environment, which would probably tilt away from most of the transportation sector, things that are heavily tied to the economy performing very well. So that's sort of how I would tackle that.
Yeah, no, I think that, go ahead, Jay, you got something to add to that?
Just real quickly, I actually totally agree with Eric in traditional correlations. I mean, it's proven. I mean, it's the data. It is what it is. However, I would differentiate in transports between the different segments and the different valuations. You have, for example, trains, rail lines are trading at price to earnings of 30 to 40 times. You got regular airlines at 15 times earnings. And then you look at some of the stuff we're doing, like, for example, Zim integrated ZIM, long that one, just for disclosure. But that's an ocean liner. They trade at 1.4 times expected earnings this year, and they're debt free. So like I know Eric wasn't doing this, but it's easy for folks to just throw transportation all in one bucket. It is important to slice in and see what the valuations are, because it's hard to go much lower than 1.4 times earnings.
Yeah, no, and debt free, right? That's the old Peter Lynch model. When does a company go bankrupt if it has no debt, right? So the big question is we've been talking about inflation and supply chain disruption, and I think we can all remember back for airlines, since we've been talking about airlines. We used to be able to walk on planes and not have to pay to check our bags. And then, of course, the moment came when all of that changed and the airlines had to do that to increase their revenue, and it stuck. And some people thought it was going to go back the way it was supposed to be, but it didn't. So we're looking at the prices. We're looking at inflation now. Not saying that we're entering deflation, but at this point, Michael, we were referring to prices maybe sticking at where they are and continuing to rise from here. And I also think about, for investors, they want to know where the money's going to be going. So they think about the consumer. Where's the consumer spending money? The consumer might be spending money flying around the country or going international, or international travel coming here since we just opened the borders again, right? So from an investor's mind standpoint, how do we really break this down if we're trying to think about where the revenue will be going and what investments we need to be making now to capture that as yield for ourselves?
So I know everyone jokes about Facebook and the name change as a distraction for all the problems they have, but it's a large company with a hell of a lot of data, and clearly they see something very opportunistic in terms of the metaverse. Now, I joke about this nonstop on Twitter because it's remarkable to me that we got to a point in society where people would rather be in a virtual world than live in their real world, right? But with that comes a lot of opportunities, right? Because it's a source of entertainment, it's a source of distraction, whatever it is, there's money to be made there. And I'm sure that Facebook is, as an organization, smart enough to see that coming. So I'm sure that's a mega trend. As absurd as I think a lot of this is, that seems to be where a lot of the money is going. It's interesting, right? Because it seems like that's how you can distract the population from the fact that the wealth gap keeps widening in the real world by giving them fake money in a fake world, right? And making money off of that. So I think that's kind of an interesting direction to think through. Real quick on the growth decelerating point. I mean, wow, if growth is decelerating, Eric, then after all this and this infrastructure spending and the bipartisan bill and all the stuff that's coming, I mean, what's it going to take? Because you and I both know the velocity of money doesn't want to pick up. You and I both know demographics are still against everybody, unless you're in a virtual world, right? How can we ever get real growth that takes care of all of this debt and justifies valuations?
Well, you were making a really interesting point in the prior segment where you were talking about lower yields facilitate more debt. That more debt means you have to have lower yields, and then that cycle continues and continues. The Bank of International Settlements has a name for this. It's called a debt trap. And because it's a trap, you really can't get out of it. The only way you can really get out of it is by clearing the debt burden, which McKinsey did a great study. You can only do it really through a rising net national savings rate. Despite popular opinion, you cannot inflate your way out of this. One simple point that a lot of people gloss over when talking about inflating our way out of the debt is that the largest source of our future debt burden is all of the entitlement programs, Medicare, Medicaid, Social Security. All of those programs are linked to inflation. So we had a 6% cost of living adjustment for Social Security. So you run the CPI at 6, 7, 8, 9% this year. Next year's spending is just going to be 6, 7, 8% higher. So no, you can't inflate your way out of it. But what we're trying to do is every time, basically we have structural growth, and structural growth is comprised of population and productivity. Those two factors together, we can argue about it. My estimates are that in the post-COVID world, we're looking at about 1%, 1.2% trend growth. So every time the economy has a cyclical ebb and flow around that trend, as we start to decline, politicians try and avoid that cyclical decline, and they usually try and avoid that by spending more money, which means they have to borrow more money, which means that the debt load increases. It causes a very transitory boost to both growth and inflation. It quickly recedes, we're talking about a nonlinear relationship. So what that means is that in a prior world, 10, 15, 20 years ago, the government borrowed $1 trillion and spent it, they may have gotten 4, 5, 6 quarters of good growth. That we've triggered the diminishing returns so aggressively that we're now at the point where we've borrowed $5.7 trillion over the last 18 months, and real final sales in Q3 was already negative. So we've hit this point where all of these borrowed funds come and go within basically a quarter and a half tops, and then we revert right back to that trend. And that's where we're headed now. We have the economy that got this supercharged boost out of COVID, had a lot to do. There was fiscal policy, there was behavioral changes, we're shifting consumption to durable goods, a lot of things going on. All that's happening now is growth reverting to trend. Everyone keeps thinking that the growth is going to stop and level off at a higher level than it was before. Problem is the economy is cyclical. It always moves in a cycle. There's no such thing as going to 2% and then growth moving sideways. You're always going to move in a cycle. And right now we're still cycling down until the next catalyst that's going to push us higher. But if it's debt financed, it's just going to push us higher for a very short period of time before pulling us even lower. So as a really long-winded answer to your question of there's really no way out of it other than several years of a rising and sustained rise in the savings rate, which on the flip side would be the opposite of what I just said. It would cause a short-term pain. It would cause a short-term hit to economic growth for the first 1-2 years. And then on the back end, we'd start to get better growth as the debt burden was lessened. But from a politician's standpoint, with 4-year election cycles and really 2 years before your next campaign, no one's really going to want to take that 2-year hit. So the debt trap continues, and we'll have these weaker and weaker transitory spurts of growth around the declining secular trend, is how I would answer that.
So are we saying that the consumer is going to be saving more money, which therefore would slow down this growth that we've been seeing? So doesn't that kind of line up if we're going that direction and people aren't spending and they're sitting on cash, which people aren't making money on their cash? I mean, banks aren't offering high interest rates, and we still have fund managers and everybody else that need to outperform. Like, where do we turn? And I know there's been a lot of escalating price prediction levels for the indices going into next year. So where does that come from?
It's a great question. There's, as far as the savings rate, I would just make one point that the savings rate, the consumer is only one portion of the net national savings rate. There could be corporate savings, household savings, government savings, and foreign savings. So a rising net national savings rate just means that the savings has to come from one of those sectors. None of the sectors are saving sufficiently now. So in aggregate, you take all those sectors and put them together, the saving rate's only about 2%. And that's obviously growing much faster than that. So from my framework, if we take a little bit of a longer term view, Michael's got more risk on, risk off. He may be a little bit more tactical for the short term. But if we look out over 2 years, 3 years, 4 years, if we're going to be stuck in this declining growth environment where growth is going to basically be staircasing lower year after year after year, what that means is that when you can find growth, that growth is going to trade at a premium because growth is going to become more scarce. And that's been behind the secular rise in, the NASDAQ versus the Russell 2000. The Russell 2000 can outperform the NASDAQ for maybe 3 weeks at a time. And that's about it, because the Russell 2000 is very sensitive to the actual growth that's going on in the real economy, which is evaporating every day. The technology stocks have legitimate revenue growth of 10, 15, 20, 30%. And if you're in a 1% growth world and a company's growing at 20%, there's really no, I guess, mathematical way you could put a real valuation on that. And then this starts to get really wonky if we try and push this out 5 or 10 years. If the growth rate in the economy is sustained at -1%, which means most companies are actually shrinking in terms of their revenue. This is a Japan type scenario, but then you have 1 or 2 or 5 companies that are still growing at 20%. What price can you possibly put on those companies? So if you believe that we're going to be in a declining growth world, as I do, you're going to want to find companies that do have legitimate revenue growth. You probably have to pay a premium for those, but that premium should continue to rise as the growth rate of the economy falls.
Yeah, Eric, you might be the bearer of bad news, and hopefully not, because I know a lot of people want the Roaring '20s to actually happen. But maybe
no, but hold on. Can I hit on that real quick? Because this Roaring '20s thing to me is a little bit insane. It's like, I don't know why everyone is so hyped on this idea that we're entering this decade of incredible growth. Because what happened after the Roaring '20s? You had a Great Depression. Like, what are we talking about here? I mean, we entered this kind of really bizarre world where everyone seems to love capitalism, but nobody wants to take the loss of it. Nobody wants to take the pain of it. I mean, we got to take a step back and like realize that there's other dynamics here which are beyond making money in markets. They're actually very damaging to society if it gets to the point where who cares about education? You can throw money at any kind of meme coin and be a multimillionaire. Who cares about risk management because the Fed's always got your back? Who cares about taxes because taxes don't matter because you can print money? Like all this, we got to take a step back for a moment and like, I think kind of tone down the rhetoric that this is such an incredibly bullish environment, because there's always unintended consequences, which will be very negative in ways that nobody ever sees until after the fact.
Yeah, I think to put it in 2 words, moral hazard and creative destruction, if we're looking at it in economic terms. It's such an important point, and I hope we're not running out of time, is that going back to what I said before, structural growth is a combination of demographics and productivity. Demographics are what they are. They're declining. They're declining in the US, Japan, China, the United Kingdom, Europe. There's really no way we can avoid it. And it's not going to change over the next 10 or 15 years, even if everyone started having kids today. So demographics to one side, productivity is the other side. What Michael's trying to say is part of capitalism and part of increasing productivity in the economy is when there's a downturn, the least productive companies get cleared out, more productive companies come in and they create efficiencies. But we're in this environment where we're using debt. We're not printing money. We're using debt to keep unproductive companies afloat. Then we have the additional debt burden and we have unproductive companies that are getting to stay around. Those 2 things are contributing to a decline in overall productivity. And when you marry those 2 together, you have declining demographics, declining productivity. That's what's causing this perpetual decline in growth. I think it's such a critical point that you made.
I just want to ask, how does the metaverse impact supply chains? Can I ask that?
That's a good point. I don't know. We got to ask Jay.
Oh my goodness. Well, there actually have been folks who ask me in all seriousness, what happens when 3D printers are widespread and shipping is rendered obsolete? So people ask me that with all seriousness. Obviously, once you plug in the economics of it and figure it out, it doesn't stand. But a valid question, though, very valid question on shipping is what happens when spending shifts away from durables and stay-at-home type stuff and back to experiential products, air travel, vacation, and such. And yeah, hopefully we're going to see that soon. Nobody wants to stay locked up and under these COVID situations forever. I think we're going to see that. And that's why we look at the inventories, regular inventories, normalized inventories, regular sales levels. And if you look at the inventory levels going back to 2019, 2020, 21, we still haven't even caught up to historic inventory levels, let alone the fact that we have higher sales numbers. So even if sales numbers pull back to 2018, 2019 levels, we still have inventory replenishing to go. So that's how I'm looking at that. Long-term, 5-10 years, I'll let Eric and Michael focus on that one.
And Jay, when you look at those inventories, you obviously mentioned a lot of metrics that you look at. How are the autos impacting those numbers? If you exclude autos, do those inventory numbers look better, or are they pretty much the same?
Well, they certainly look better because the auto shortage, the used car shortage was the major player. So anytime you're looking at containerized goods, you have to strip out autos. So I'm glad you brought that up, Eric. Yeah, you'd have to strip that out. But even when you do, you still see we're about 10%, 5 to 10% below the 2018, 2019 sort of levels. And then the second point I want to make on that is the supply chain crisis, if you want to call it that, has taught us that this decade-long trend towards just-in-time inventory is a little risky. We got the first wake up call with the US-China trade war, trade tariffs, if you will, and we got the second wake up here with COVID. So as tensions are rising with China, as folks have got this COVID wake up, I think we're going to have to see a little bit of a reversal of that trend. We're going to have to see higher inventories to sales ratio going forward. It's just not sustainable, the trend that we were on.
By the way, it's not a 3D printer behind you, right? Just to be clear.
Not yet. I'm watching every day for that 3D printer that's going to render all the ships obsolete.
It's stuck in a cargo ship off the Bay of Los Angeles right now. All right, guys, before we wrap this up, let's go ahead and just go around the horn. I want to give all of our viewers a good insight into what they should be watching. So, Jay, why don't you go ahead and highlight what you're watching right now within the shipping industry that investors might need to look into?
Yeah, for trading, the number one thing we're looking at are those dry bulk rates. We're trying to see how far they're going to keep coming down, if they're going to stabilize. We're really looking at the mid-sized dry bulk rates, not so much those large ones. Those large ones are skewed by iron ore. In the mid-sizes, we've seen stability over the last couple of days, but going forward next week or two. So from a short-term trading, we're looking at dry bulk. Longer term, I'm watching those freight rates, and I'm watching that supply chain congestion factor. I'm hoping we're going to slowly, the freight rates are slowly going to come down. The supply chain is slowly going to get better until February-ish. So that's kind of the glide path I'm expecting. But that's what we're watching. We're watching dry bulk short term, and we're watching the container ships in the medium term.
What's one of the best companies to look at in that sector?
In dry bulk, we really like this company called Eagle Bulk, EGLE, and I'm long the stock there. I think a lot of our members are as well. They're focused only in mid-size ships, so they're not exposed to the iron ore trade very much at all. They trade around, I think, 41, 42 today, and their net asset value, which is just the ships minus the debt, and that's updated as of like last week. So this is current valuation. It's not some artificial accounting value. It's about $72 a share. So you're getting a pretty huge discount. They're paying $2 a quarter in dividends. So at $8 a year, and it trades at 40, so 20% yield. And then the one in the container ship space we really like. I'm not sure when this is recording is going to be posted. They're actually reporting Wednesday morning, November 10th, is GSL, Global Ship Lease. The cool thing about them is they've fixed almost all of their ships on 3 to 5 year charters. So whatever happens with freight rates, whatever happens with the container leasing rates, frankly, at this point, it doesn't really matter. Most of that value is already locked in, and they're going to be important results here soon. We're long that one as well, of course.
Great. Michael, what do you have for us?
All right, so the name of the show is Alpha Insights. I always make this point that alpha doesn't come from being up more, it comes from being down less. That's not a very popular opinion. That real outperformance, real wealth generation comes from not losing. And it's hard to lose sight of that in years like this year, right? So I think that investors should prepare themselves for more volatility, more risk, and don't get sucked into the thing which is going up at a faster pace than everything else that you think will make you rich very quickly. I always go back to these two stats: up capture, down capture. What percentage of the upside is your investment capturing against some benchmark versus the downside? If you use the baseline as the S&P and you capture just 50% of the upside on the S&P, and you had a down capture of effectively 0, you would be up 3.5 times more than the S&P going back to 2002. Even though you're lagging on the upside, and markets tend to go up more often than they go down. My point in emphasizing that is we are entering an environment where people are forgetting that risk matters. Okay, now, how do you adjust for that? Selfishly, take a look at the lead lag report, but it's always worth saying to yourself, am I really properly diversified against the extreme declines? Diversification is not 5 stocks. It's not 500 stocks. Diversification, to me, I always say, is defined by having investments in your portfolio that you hate. Because if you hate an investment in your portfolio, it's not working, at least for now, in an environment of pure up capture. Think through how you're allocating your investments. Think through positioning, not just in terms of the winners, but also the losers. And think through how much exposure you want and how certain you are about a future, which nobody can tell what tomorrow brings.
Yeah, great points. Eric, bring us home.
So I'll echo what Michael said. All his points were great. I agree that if there's ever a time to be cautious, it's when both growth is slowing and the Fed is tightening. That combination generally leads to more market volatility. And again, this growth slowing characterization is empirical. It's not a subjective opinion. What I would tell investors to look at is three things. Even if you're an equity-only investor, I would really implore everybody to not look at the equity market for any economic signals, because equities are historically a poor leading indicator. Then the ownership of equities in terms of the profile of people is extremely narrow. There could be 8 million people on their couch on Robinhood, but they're all the same profile of person. You could have hedge funds, you could have a couple other people. But when you look at the treasury bond market, when you look at US dollar FX market, that genuinely impacts every single player in the entire global economy, from foreign central banks, foreign businesses, foreign pension funds. Everyone in the global economy's got to touch US treasuries and US dollars. Those markets are also much deeper and much more liquid than the equity market. So you're going to get much more reliable signals economically from those markets. The second point is, if you're trying to look on a day-to-day, week-to-week basis, you're going to get whipped around. So with those two things in mind, what I would be looking for, especially as we're entering this environment where the Fed is going to be tightening policy, is one, the yield curve. Yield curve flattening would be a growth slowing signal. The second thing would be the US dollar against what I would call commodity sensitive or cyclical currencies. So you think about the dollar versus the Australian dollar, the US dollar versus Canadian dollar, Brazilian real, New Zealand, South Africa, Chilean peso. Those are the types of currencies you want to be watching against the dollar. If the dollar is rising against those currencies, growth slowing signal. And then you want to look at the commodities that those countries are producing. So, and commodities that are generally sensitive to growth. So things like copper. So if you take those three things together and you see yield curve flattening plus dollar rising plus commodity growth slowing, textbook growth slowing signal, regardless of what the equity market's doing. So those are the things that I would be looking for. And to give everyone a head start, those three things are happening at the moment. So those are things to be cautious about.
You understand this.
If you understand.
He does. He does. There are a few, but he definitely does. Well, thank you so much, gentlemen. I really appreciate the discussion today. I hope all of our viewers do as well. And, as I mentioned earlier, all of their services are found on Seeking Alpha Marketplace. We have Sifting the World with Chris Demuth Jr., Lead Lab Report with Michael, EPB Macro Research, and Value Investor's Edge. So everyone, hope you enjoyed, and we'll see you next time.